I didn't want to steal. All right. So Christy will be chairing today's meeting. Chair Kurt Kawafuchi will not be able to attend today, but we have quorum.
Yeah, so I will call the meeting to order, and nice to see you all. Was there any communication to the council?
There were not any.
Not any. Anybody out there in the cyber world who is commenting?
I'm checking the chat box. I don't see anything yet.
Okay, I think Kurt usually paused a little bit to make sure. The next item on the agenda is approval of the minutes. Now, these were circulated in advance. I entertain a motion to approve minutes.
So moved.
Thank you, Scott. Is there a second?
Second. I'll second.
Okay. Is there any discussion? Okay. Carl, how do you vote?
Aye.
Aye. Scott?
Aye.
Mike?
Aye.
Regina?
I abstain. I missed the last meeting.
And Marjorie missed also. So,
Yeah.
I
abstains.
vote,
Yeah.
I vote to approve also. So that motion has been carried. The next item is Department of Taxation announcements.
So you have heard that Seth Colby has moved on. He's got a promotion. He's going to be the new chief economist of our state. Congratulations, Seth. I am going to be filling in for the time being as the acting tax research and planning officer. So I'll be directly supporting the Council on Revenues and enhance the support part of the support team here for this meeting today. I just have provided you with the workbook, and I want to highlight a few things from the workbook after we get started. But I also want to acknowledge Marjorie Bennett is our new member. I don't know if you would like to say a few words about yourself to the council. So welcome.
Yeah, thank you, Baibar. Appreciate it. Yes, it's my privilege to serve. It's an impressive group of people here. Just a little bit of background. I was born and raised on Oahu, and did my career and my education particularly in the Bay Area of San Francisco, and then part-time, full-time, part-time, full-time resident here on Kauai. My background's in wealth management with my CFA designation. And so when I was asked if I wanted to sit with this council, it's all the information I work with on a daily basis, and I love it. And so it was an opportunity to give back to my community. So of course I said yes. So it is absolutely my privilege to be here. Thank you.
Thank you. And I've shared with
welcome.
Yeah, thank you.
I've shared with Marjorie a presentation I had given 3 years ago about total personal income. If anybody is interested to refresh their memories, I can send it out again. But I just want to highlight a few things. I know you're given a workbook and with no narrative explanation. Just to refresh our memory, I want to share, direct your attention to a few things, if you don't mind. So what I want to highlight is starting from where we were standing from last year. So the forecast for 2024, the council's forecast was 5% for the growth rate of total personal income. And our model in August, so we have 2 meetings in a year, right? The first one was in August. The average of the models was 4.68. And as of June of this year, we have the 2024 preliminary actual growth rate that stands at 5.55. But in the October meeting, the council had revised its forecast to 5.5%, which is right on the dot, with a little rounding error maybe. And then the average of our models was 5% again. Now, the thing that I want to point out is, so this is going to be in table 3. This kind of shows what happened last year. But I also want to mention something that I had brought up before. The Bureau of Economic Analysis does revise the data. So as you do make a forecast, and then it might go back and revise the last 5 years even. So like I just want to highlight here, these are the numbers that were published up to 2023 last year. So in June, like for our first meeting, we have what we call the preliminary numbers. And if you look at it in 2022, it would show a growth rate of 0%. I just highlighted the numbers that have changed, the revised numbers that are in yellow. So obviously, if you're talking about a different base, then the growth rate also changes. So it's something to take into account. It's not that sometimes the council is completely off, but it's just that the numbers get revised. But more or less, the growth rate was similar. If you look at 23, it would be 5.3% in the preliminary and 5.5% in the final. And lastly, so where do we stand? So last year, the council does forecast the calendar year. So this year we're going to be forecasting 2025 and 2026. So in last year's October meeting, the forecast by the council was 4.8% for the calendar year 2025. So what I have in table 4 is all the 6 different models and their averages that are coming from our models that we have covered in the past. And those numbers are 4.96%, about 5% for 2025, and about 4.7% for 2026. The other information that is in table 4 is kind of comparing this to other sources. So one of the other independent sources is obviously UHERO, led by Dr. Bonham. They have their quarterly forecast, and their numbers there were 5.1% for 2025, 4.4% for 2026. Mind you, this is as of May. And then we kind of have the DBET forecast from their also quarterly report. And then the last time you met was in May for general fund, and all the council members provide their forecasts for various economic variables, one of which is the total personal income. So here we also have those and an average of all the council members. So that was 579, and a bit more optimistic here than the rest of the forecasts. And then the one that is above it is the simple average. That's coming from our own models. So in the next slide, so what we're doing then is taking the average of all these averages is the number that is at the bottom. So the average of all independent forecasts includes your forecast from general fund, DBET, UHERO, and the models that are in the book that are in tables 5 through 10. It's just a reminder. There's nothing new here, but please feel free to ask any questions. And I pass it on to Christy.
Okay, very good. That does give us a lot of perspective. So thank you.
My pleasure.
Well, I'd like to start off the discussion or ask Carl to start off the discussion. What do you think, Carl, as far as our forecast for?
I think, actually, I mean, if I were to pick a set of numbers, the table 5 on page 7 of our handout shows the average. Let's see, I think that's oh no, that's the single equation model. I was looking for the average of the averages. That must be,
I think it's
That's
table 4.
table 4.
Table 4. Yeah, thank you. The simple average of all the models. So I would discount the Council on Revenue's forecast for May is way too high. 5.79 just seems very much out of reach. And I would say when I run our model right now, I get 4.95. which is the same thing. It's just the simple average of all the council's models. And when I run my model right now for 2026, I get 4 point, I gotta look it up, 4.7. And the simple average of the council's models is 4.64, 69. So if I were to pick one, I'd pick the simple average of all the models, and we'd be done. And I mean, there's obviously
shortest meeting. No.
There's a whole bunch of crazy stuff going on in the world. But I mean, Hawaii started off the year on a pretty strong note with surprisingly strong job growth. In hotel, I mean, the hotels are adding workers, retailers are adding workers. I think we're probably in the top 5 for year-over-year job growth in the whole country, which is kind of surprising. But if you look at the data for the last few months, that the monthly changes have really, they flattened out, right? So there was a surge, and the year-over-year comparison is comparing to weak start in 2024. So what I'm getting at is that we started off pretty strong, but I think we're heading for that slowdown that I think most of expected, and it seems like we're also getting that slowdown in tourism with the June numbers for arrivals were weak. The July passenger count data is weak. Basically, everything's weak other than U.S. Right? It's all the international is incredibly weak, but that's already built into the forecast that both the council and the models that tax runs and the model that I run. So I'm comfortable with something like 4.9 and 4.7, or 5 and 4.7.
So Carl, with regard to your model, I guess Medicaid is transfer payments, right? So that would factor in here. And with that big, beautiful bill, do we know how much of an impact the loss might be?
So that won't show up until the end of 2026, right? So they intentionally wrote this bill so that none of this would directly impact people until after the midterms. And so technically it's not impacting this forecast. There are estimates of how much the state will lose in terms of funding. And the estimates that I've been relying on come from the Kaiser Family Foundation, and they've done this for every state in the country. And of course, they're highly uncertain because it depends on how many people actually lose coverage. And their estimate, if I remember correctly, was about $400 million a year for a decade. But even with the changes happening at the end of 2026, states can request an extension. So if we're making a good faith effort to, get all of our ducks lined up so that we can deal with the changing work requirements and try to track people, because you have to verify their work requirements twice each year, and you have to verify their addresses, a whole bunch of stuff that DHS is going to be struggling with. So there's a chance that deadline at the end of 2026 will actually get pushed back farther. And then there's another piece in this bill, the bonus program they threw in there for Senator Murkowski and a few others for the rural hospitals. If I remember correctly, I'm pretty sure there was $50 billion for support of rural hospitals, and that fund, you have to apply for it, and you have to explain what you're going to do with it, and you have to get the application in by the end of the year. So none of it's guaranteed, but that money was supposed to be split evenly across all states. And I think the fund was 50 billion, but 25 billion of it was going to get split evenly. So I think there's about 500 million there that could show up in our economy and provide some boost that could help to offset other losses, even if the Medicaid losses don't materialize until 2026. Right? I think we're still going to see the federal civilian job losses and non-federal civilian. So UH employees at DOE or other state agencies and county agencies as well, and of course private sector. Yeah. Sorry,
Yeah,
long-winded answer. You should never ask me a question.
At some of our earlier meetings this year, we had long discussions about the impact from DOGE and U.S. cutbacks on federal employees. Do you see that showing up in any of the numbers, or is it just too early to tell?
I think what we're seeing is, we are seeing a decline in federal civilian employment, but my interpretation of that, if I remember correctly, I want to say it's about 1,200 jobs drop. And when we did our analysis of what might happen from DOGE cuts, we came up with 1,700 jobs. But I don't think these 1,200 are DOGE cuts, because the DOGE cuts were kind of like the tariffs. They were on one day and off the next, and legal one day and illegal the next. And I think what we've seen is the effects of the hiring freeze that you have probably heard about, where there's been some discussion of it with respect to FEMA and NOAA, and so the numbers would make, if you had a hiring freeze, just attrition, right? Just people retiring, and could lead to those kinds of numbers. But the next step is in the reduction in force efforts, right? Where pretty much every federal agency has been required to come up with a plan for how they're going to reduce their workforce. And those plans are going through the process, and it takes longer because it's legal, because you have to do it the right way, and you have to give notice to the unions and so on. But I think we're still looking at, it's not in the data yet, I guess is what I'm saying. I think it's still coming.
And what is your inflation forecast for 25 and 26?
Yeah, good question. Let's see.
Because
I don't think it's changed all that much. Let's see. It's gone down a little bit. So since our last forecast, it's for 25, and this isn't necessarily exactly what we'll release when we do our third quarter forecast. This is what happens when I run the model now. And we had inflation came down to, I think the last data point was 2.7%. Our forecast for the whole year is 3.7%. So that strikes me as a little bit high, but yeah, we'll see. And then for 2026, our forecast is 4.6%.
Whoa.
Well, if you look at where the tariffs are right now, so the average effective tariff rate today is probably, I haven't looked up the data since the recent announcements, but I'm going to say it's probably 18 or 19%, and it started the year at 2.5%. Okay, and so every 1 percentage point increase in the average effective tariff, and so if we go from 2.5 to let's say just we went 18.5, so 16 percentage points, and every one of those is roughly 1/10 of a percentage point on inflation. So we should expect inflation to jump by about 1.5% over and above what it would have been otherwise. So if we're at 2.7 in May, and if you thought that was going to continue, let's say you thought it was going to be 2.5 for the whole year, then you ought to be at least at 4. And so, yeah, 4.6 might be a little on the high side. That wouldn't, so it won't surprise me if our forecast comes down a little bit. But the data, the most recent data, obviously for the country as a whole and for Hawaii, have shown increases in inflation.
And it seems, Carl, would you agree that I was reading an article that it's kind of buried a little bit too, in the sense of right now a lot of the companies are eating some of the tariff impacts, and that they've already expressed noted that they are going to be increasing prices, and they're projecting that that's going to happen potentially later this year, which obviously will drive things up.
Yeah, I mean there's all this. There's so many things going on with why you might not expect to see the price increases right now. Everything from, I mean, in many cases the tariffs weren't actually in place, right? They were promised and then backed off and then promised again, and businesses avoided them by front loading their imports in
Mhm.
before April. In a big way, that caused huge swings in the GDP numbers. We had the biggest increase in trade in the first quarter of the year and the biggest decrease in the second quarter in history. So
Yeah.
there's a everybody is doing everything they can to avoid the tariffs, and so you shouldn't expect them to be in the data right now. They are showing up pretty markedly in the prices of imported goods, particularly furniture, clothing, some in appliances, and and then businesses are eating these. Some businesses are eating these for a little while because why would you want to raise your prices and annoy your customers when the tariffs might be gone next week? And they might be gone next week. I mean, they're in court today, and of course, when this is the, I don't know which court it is. Whatever court is hearing the this was a stay, right? There's a court for International Court of Trade or something like that that said this was illegal, and then that was stayed like the next day, so the tariffs went back up. Now they're hearing it again. Whatever happens, it'll get appealed and presumably will end up in the Supreme Court. So, but it's really fascinating to see the market act like the tariffs are gone, right? And because, I mean, so I was talking with a retailer, a Hawaii-based retailer who sells water sports equipment, and they told me that just in the last 2 months, they've had several of their suppliers raise their MSRP twice, and they've never had that happen in the past. I mean, because it's crazy. Most of the time, businesses will set their prices at a specific time of the year, and that's the price for the whole year. You don't see these kind of jumps all over the place.
So you're basically, though, when you factor in inflation, uh, uh, expecting personal income to be flat for 2026.
Absolutely, yeah. In our May forecast, the forecast was like minus 0.1
Yeah.
and or minus 0.2, and now the forecast would be roughly 0. And that's purely because of the momentum from the strong start to this year.
Well, thank you, Carl. Carl is suggesting 4.9 to 4.5% for 2025. Regina or Mike, do you have any comments on that?
Mike, go ahead.
Well, to confirm what Carl was saying, actually, couple of retailers that we've interviewed as well mentioned that those retailers that have gone vertical in terms of handling their manufacturing as well as their distribution all within their own structure have been able to avoid significant increases in their pricing. So the successful ones are the ones that have integrated, or found alternative sources for their products or their manufacturing. So that's kind of interesting from that perspective. And you're absolutely right about the front loading, because we've seen our retail market's actually fairly stable. We've actually returned back to levels prior to COVID, and I was surprised just to hear that,
Yeah.
from perspective. So we're I don't know, maybe it's just a calm before the storm. It just seems like we're stabilized and we're not everybody's freaking out as to what's possibly might happen towards the end of the year. So I guess if you're asking me a question, I think I defer to Scott from a construction perspective. haven't seen much of a slowdown in development activity except for maybe those that are requiring to import goods from China. But you know, I guess if we were looking third quarter, it looks kind of stable. I mean, I'm not, I'm not as worried at this point with all the changes occurring in the trade market, but I don't know. That's kind of just my commentary at this point.
Mhm.
Yeah, and from a construction perspective, Mike, yeah, it seems to be somewhat steady. I mean, I think the projects that have started and are on the books, I mean, they're moving forward. What we're seeing is slowdown. It's stuff that hasn't broken ground yet or hasn't even gone to design yet. Some of those are starting to push out a little bit. It's not that they're being canceled; they're just kind of slowing down, and it could be a variety of different reasons for that.
So
So I
Scott,
have talked sorry, go ahead,
no,
Martina.
that's okay. Scott, I just wanted to follow up on that one because that was my question about when are we going to start seeing the impacts of these potential tariffs on the construction? So maybe is that why people are delaying because of the uncertainty with tariffs or?
So what I've heard, and it varies, it depends on the size of the construction company. For the smaller ones, they're just have to deal with it as they can. But for some of the larger ones, they're either buying futures or they're already, they've already brought in tons of material, and a lot of them have tried to front load it. So bringing timber, bringing steel, whatever they can, to address some of that. So it depends on the size of the project. I think we're probably going to see the bigger slowdown and bigger impact is the residential market, the smaller stuff, because that's where you're dealing with smaller contractors that don't have the capital to go out and buy enough material to build an entire home now. And so they're kind of going as they can.
And where are they warehousing that stuff? The larger firms that you're talking about. I mean, and what are the additional costs associated with that?
It's big, so that's why a lot of them they're storing at their base yards or wherever they can. And if they're able to, they're buying futures, so they're locking in prices now for the next year. So I think it just varies depending upon the size of the contractor and what they have available to them.
So what I'm hearing from developers, one is that they're facing on a big project hundreds and hundreds of millions in added costs. And two, they can't get pricing for more than a few weeks or a month, right? So if you're planning a project for a year from now and you want to buy it forward, you can't. I mean, you could write a contract, but the price could be whatever it's going to be at the time that delivery. I don't know if you guys saw the news stories about the ship loaded with copper that was headed for Honolulu because of the 50% copper tariff that goes into effect tomorrow. And so it was coming from Australia and it wasn't going to get to Long Beach. So it changed its course to head to Honolulu to try and get through customs. I don't know if anybody, so I don't know, Mike, if you can see the harbor, but you might look out, it might be there. It's probably not shiny copper, but and it would probably have an Australian flag. But then Trump changed the rules on the copper tariff. So to where some of the copper, I can't remember what the exact distinctions are, but some of the copper is not going to be tariffed at the 50% rate. So all these people who were trying to arbitrage and bring in cheap copper and then sell it with the 50% mark. Anyway, yeah. So what I'm hearing is a lot of uncertainty. So the way we look at that is that will lead to particularly smaller projects, not just smaller projects, but things that are in planning stages to start getting pushed back. And if the steel and aluminum and if those tariffs stay in place, then some of those projects just aren't going to pencil out, and they're just not going to happen. And a related anecdotal story is I was shopping for a refrigerator, and I made an initial decision. I said, okay, I'm going to buy that model. And then the salesperson called me and said, well, we have this other model. It's actually exactly the same model. As best I can tell, it was the previous year's version. And it was about 15% cheaper for something that's exactly the same. So if I had brought in the new appliance, I was going to pay the tariff. And so there are price changes out there. They're not always obvious to the consumer. And yeah, but in the construction field, there's another story in the construction field. There was a very large NAVFAC contract let, like something on the order of $8 billion. And that was about a month ago. And none of the money has flowed yet, but so we are working on trying to sort out how much we're going to raise our forecast. It looks like it's mostly for demolition. I don't know if you looked at that or not, Scott, but it's spread across a whole bunch of like a Hawaii dredging and a Nordic and a et cetera. And when I've talked to some of the construction companies, they haven't yet seen any money or any task orders. And it's spread out over about 5 years. So that's encouraging that federal money didn't just suddenly dry up. And then the other thing that may very well be coming is the stadium. We haven't put it into our forecast yet. I think when they start demolishing the old one, then we'll probably put it into the forecast. But that has the potential to hold up. Those two things together could make the difference between construction starting to wane and construction staying at a high level.
Yeah. So, Carl, you're absolutely right. That $8 billion contract for the there's no, as far as I'm aware too, I haven't heard of any task orders because I think we've talked to a couple of those companies, and I don't believe there's any task orders yet. And then there's the stadium, and then also the SIOP out of Pearl Harbor. They've still got huge plans and that goes out for another 20 years or so. So there's potentially a lot of federal spending still in Hawaii.
And since we're talking construction, the permit data has been very strong for the start of the year. That mostly reflects current activity. It doesn't, unlike I should have passed this on to Seth, but building permits for high-rise construction are not leading indicators in Hawaii. They're coincident indicators because the permit gets issued a few weeks before you move into the building. It's just the way that we do things. It's very odd, but that's just the way we do things here. So there's a lot of, I can't remember the numbers. I would say that total residential permits are probably up in the 20-30% range for the start of the year.
Well, Marjorie, do you have any comments or questions?
I just want to say, as I've been appreciating the conversation, particularly with on the construction level, the long-term nature of those larger projects, they require, as far as you guys know for yourselves with how your contracts are formed though, but the analysis to step into it, some things do get locked up on the front end, and the materials can become such a large component of make or break a project that I can see the need for the front loading to try to find some sort of certainty associated with it as best can. The other side of it is I've been reading about the influence though with the tariff prices on imported goods is it's leading to incentive for domestically produced products to raise their prices to still be competitive, but it can also produce a bit of a profit incentive along those lines, much like the alternative energy credits that have been used in the past. The other big component, though, within all of this is wages and salaries. And many firms are not letting people go. And there's a lot of people who aren't leaving their jobs because of the uncertainty that's happening. So we're getting, in the younger generation, some underemployment that's happening. And there's ghost postings that happen. People apply. There's actually no job that's there, which I think might be as a result of companies trying to protect themselves from the material side of things. So I'm looking at these numbers here, and I'd have to agree with Carl that the last round of numbers seem a bit optimistic. And given everything else that we're seeing, is that it's good to revisit this for another estimate today. So, yeah.
And Marjorie, one comment with regard to the materials in construction. So you're right, you try to front load it, but in cases for us, like with regard to a lot of state contracts and federal contracts for design, in a lot of cases there's a redesign clause. So what that requires is that if when they actually go out to bid, or when they're doing the estimate of construction costs, if it exceeds what they budgeted, we redesign. So we have to go back in, and so basically we have to take that into account, and so the building may shrink or whatever else. So the materials may cost the same, but you may have less of them. So that ultimately impacts the size of the project at times. So they may shrink, even though as the costs go up, that basically the design of the actual structure or the site changes.
So, Marjorie brought up the wages and so, we have one data point, 1/4 of data for income, for total income, which is what we're forecasting. But we have the first 6 months of payroll jobs, which are up 2% through the first 6 months of the year. And we have 6 months of wage data, and the wage data are 3%. So 5% seems like a decent number or 4.9 or whatever, is definitely in the ballpark for, I mean, that's what we have for the first half of the year.
So Carl, sorry, one more question on the wage data, because we're hearing all this stuff about AI. So, will that factor into it, do you think, as far as, obviously,
I don't think it will this year. And I mean, if anything, you might actually have some additional hiring specifically to deal with AI right now. I don't really think we're at the point where we're looking at job losses because of AI. And honestly, I'm actually not very worried about that period, just because I mean, we don't have a lot of labor force growth. We have had a surprising amount of labor force growth this year. I'm not sure where those people are coming from. But long term, there's no place in the country that is really facing strong labor force growth. So I think we're gonna need all the AI we can get.
So Carl, what sectors are they particularly where you're seeing the most labor growth for us, besides construction?
So actually, it's almost across the board. That's the other thing that's really unique about Hawaii, is that virtually every sector, the strongest sectors are consistent with what's happened on the continent, which is leisure and hospitality, and healthcare have been by far the strongest sectors. And then really the only major sector that was losing jobs was federal civilian. And so I mean, construction's up 2.3%, manufacturing 2.6%, all service providing's up 2%. Real estate and rental leasing is completely flat, which isn't surprising. Even finance and insurance is up a little bit, and has been a laggard for a long time. And so if you were to look at the rest of the country, it's really just leisure and hospitality and healthcare. And a lot of sectors are losing jobs nationally. So healthcare is up almost 4% year to date, and leisure and hospitality is up 3.5% year to date. I mean, the numbers are so strong that I worry that they're going to get revised down. That there's something. It's really kind of surprising.
So how does that work for us here, though? Leisure and hospitality are up, but then our tourism numbers are flat and maybe even decreasing. Like,
exactly.
What's going on? How do you explain that?
I can't.
No, I know.
I mean, that's the sense in which it's so surprising, right? I mean, the only way that I can think of it, and I think Marjorie might have mentioned this, or maybe Scott was, maybe it's. Oh, I think Mike was talking about how strong the trade sector was. And, maybe it's just that we're sort of finally catching up, right? It's that last little catch up to pre-COVID. And I mean, we're still not fully, I mean, accommodation jobs are still below where they were before COVID. Retail jobs are still below they were before COVID. But it's hard to believe that leisure and hospitality and other sectors are adding so many jobs when the outlook is so uncertain.
Could I ask another question though, just because as we're picking your brain, Carl? So I went back and looked at some of like this time last year when we had this meeting and just kind of, reflecting back on what's happened over the year. And so can you talk a little bit about how you've seen the impacts from Maui just play itself out, right? So I know we had several debates, or not debates, but discussions at last year's meeting about when are we going to see those final impacts from Maui, or are we going to see them, or how are they going to play out? So any thoughts on that, Carl?
And I think, I mean, you're probably interested more broadly, but of course the major issue for overall state economy from coming from the wildfire impacts is just the lost visitor spending. I mean, we lost over $1 billion in visitor spending because of the wildfire, and I mean, frankly, it's kind of continuing to plod along, but we're still a long ways from complete recovery there. It is still improving. Real visitor spending on Maui is up almost 10% this year, but still down about 20% from where it was right before the fire.
Yeah.
So I think there's still a long ways to go. There has been a significant amount of construction activity, if I remember correctly. I probably shouldn't throw out the numbers, but there have been a large 600-700 permits issued for home construction. The commercial side is lagging a little bit, so there's still going to be additional economic impact from ongoing rebuilding, but it just kind of feels like it's plodding along. And yeah, we're going to be releasing a report next week, I think, that sort of summarizes really the direct impacts and what the progress looks like, specifically for individuals, households, businesses impacted by the fire. And there are signs of continued improvement. So the interesting thing is, and Christy, you've looked at this, but the thing that is really confusing to me right now is that if you look at the visitor spending numbers, Kauai and the Big Island are down. Maui is up. That makes sense. That's recovery. And then Oahu has this enormous growth rate in spending, but not in people. So there's some stuff going on in the data that is a little worrisome. And
the visitors to the Big Island are, of course, the volcanoes that every once in a while are erupting attract a lot of visitors there too. But the arrivals are up, but spending not so much. Yeah.
Well, on the Big Island, average daily census is down almost 2%. For the year, and on Hawaii, the average daily census is down almost 2% for the year, and on Oahu, the average daily census is down 1% for the year. But if you look at spending, the spending on Oahu is up in real dollars 8% for the year, and it's puzzling. We'll have to talk to Seth about that.
Yeah.
Could that be possibly due to the significant increase in hotel room rates?
Yeah, I mean, actually, if you look at where is my room rate data? That's in accommodations. Hotel room rates on Oahu for the first half, I only have data through Q1 for some reason. Oh, no, that's not true. I have data through Q2. It's flat. It's up 0.3%.
No idea what they're spending it on.
Food.
Yeah, it's it's puzzling.
Well, we've been talking about this number. Are we ready for someone to actually do have a motion for a specific number?
I'll move 4.9% for 2025.
4.9%. Is there a second to that motion?
I'll second.
Okay, thanks, Marjorie. Any further discussion?
Wait, is that
You-
4.95 or 4.90?
4.9.
4.90.
Okay.
We never want to go out past the first decimal point because that just implies that we actually know something.
That we are more accurate than we
Yeah,
can.
that's
Yeah.
false precision.
Yes, yes. Any further discussion? We still need to discuss next year. So any further discussion about 2025? If not, I'll
overall,
call for a vote.
it's kind of playing out the way we anticipated then. I mean, it's not a significant change. We haven't seen a dramatic decrease or increase in any particular area. We're just kind of treading water and everything's uncertain until it no longer becomes uncertain. So, am I summarizing that correctly? Or?
I think so. I mean, I think that's right.
Yeah, I'm willing to go along with Carl.
Okay. Any other discussion? I will call for a vote. Carl?
Aye.
Scott?
Aye.
Mike?
Aye.
Regina?
Aye.
Marjorie?
Aye.
Okay, it passes unanimously. I also vote for that. So next on the agenda is the discussion for 2026. Carl, I'll ask you to lead off again.
Well, I told you earlier, I think our forecast is what, 4.6%.
Mhm.
And I mean, look, it could be 4.6, it could be 5, it could be 4.4. Those are all well within our confidence intervals. And, you know, I think we're all expecting things to slow down more than they have so far. And we're certainly seeing that in the national data with basically consumption has flatlined. And that's actually consistent with some of the latest weakness in the tourism data, right? If consumer spending for the US economy goes flat, then we really should expect that to show up in our visitor industry, and presumably that 2% or actually 3.5% growth in leisure and hospitality jobs, it's not going to repeat itself next year.
Mhm.
And so I would be perfectly happy with a 4.6 number.
Okay.
In other words, a little bit lower nominal growth and probably higher inflation. So you end up with almost very, very little, if any, real growth in the economy.
So Carl is suggesting 4.6 for 2026. Any further comments on that? Mike? Scott?
No, I think that makes sense. Yeah.
Yeah, I'm in agreement. I'm just so for the whole year of 2026, if we assume that tariffs increase for most of our trade partners, are we anticipating or projecting a slowdown in the economy, but not a dramatic slowdown? So you're saying 4.6 is kind of
Yeah.
Well, and that is a nominal number, Mike. So if we are expecting inflation of around 4.6 or 4%, it's a very small increase in real personal income.
Okay.
Yeah, but it's a slowdown, but not a catastrophe. So, you know, tariffs
I'm
don't normally, you wouldn't normally think of tariffs as leading to a recession. Of course, we also don't normally see tariff increases of this size.
Mhm.
And you do have to make an assumption, right? But I mean, the way that I'm thinking about this right now is assume that they stay where they are. And so they're elevated enough that we're going to see higher prices, and it's a tax on all the households, right? And I mean, on the households, on businesses, and some of what people will do is cut back on spending or substitute to other items, and all of that disruption, whether it's postponing a renovation or choosing not to buy a car or not to repair your refrigerator one more time.
Or come
All
to
those things.
Hawaii.
Yeah.
Yeah.
Yeah, I mean, that's kind of the real question, right? Is
Yeah.
if the typical person on the mainland is facing a couple $1,000s extra cost because of tariffs, and that's what the estimates are, between $1,000 and $3,500 in essentially tax because of the tariffs at the current level. If they're seeing that and they're seeing a little bit weaker job market, do they choose to make that trip and spend the money in Hawaii? If the stock market keeps going like it is, yeah, they probably will.
So Carl, somebody had made a comment that the typical visitor to Hawaii, because it is a destination, it's considered a luxury item to begin with. Then in a lot of cases, the visitors that may be coming here aren't as impacted by changes in prices because it's not a budget traveler. So from that perspective, in your view, is it going to be? Are we going to be hit as hard from a cutback as other destinations might be? Because obviously, Disneyland people can drive to, if they're on the mainland, but Hawaii they've got to get on a flight. So if they're planning this is their bucket list trip, they saved up for it. To a certain extent, somebody mentioned that they're going to come no matter what. So, would you agree
I think
with that?
I think there's a degree of truth to that. I mean, we're talking about people who are relatively well off. And so honestly, I was much more worried when the stock market was down 20% than I am right now. Right. And, but I'm not going to try and forecast. I mean, the stock market continues to surprise. But really, actually, if you look at where it is now versus the beginning of the year, right, it feels like it's so much stronger than it is because we went through the correction, right, the temporary correction. But if you compare it to where we were at the end of 2024, I think we're only up maybe 5 or 6%, and that's kind of consistent with what you might expect just from the tax bill and the expectation that interest rates are going to go down. And so I worry that when the tariff reality, if we stay here on these tariffs, when it starts to bite on earnings and consumers start to cut back, that we're going to see the market go down again. And then you combine that with with housing market, there's a wealth effect that it's what I worry about. We're insulated a little bit because the people at the top end aren't as affected as the average person, but we're not completely insulated.
Thank you.
Yeah, that triggers something for me. I'm just looking at, I think the stock market is up 7 or 8%. I'm just looking at the S&P 500. So
Yeah, it's 8% year to date for the S&P. It's up about 13% though in the last 3 months. So, which is coming off the effect of April. Yes.
Is there anything?
Just speaking of another puzzle.
Oh, sorry.
Sorry. Go ahead.
Is there anything in the big beautiful bill that from a tax perspective or from a business incentives perspective that could actually boost activity in 2026?
Sure. Yeah. I mean, there's a little bit there in terms of the expensing of investment, right? And I mean, most of the national research firms that are looking at the fiscal stimulus effects, come to the conclusion. So like Yale Budget Lab or MIT, they have, I can't remember what they call their group, but basically they're mostly talking about something that would boost national GDP growth by, 30, 40, 3-4 percentage points, maybe as much as a half percentage point. So you could get a short-term boost in GDP that's then offset by, if the tariffs were to stay in effect, the rule of thumb would tell you that you'd lose about a 1 percentage point off of GDP. And so you add it all together, and we haven't talked about if the effects on labor force from the migration issue. You end up with, the consensus forecast is getting pretty close to maybe 1.2, 1.1, 1.3% for the US for the whole year. That's down sharply, right? That's for 2025. And 2026, unless the tariffs go away, it's not going to be better than 2025.
You heard it here first, folks.
Yeah, but then Mike, I guess too, the one thing that is in the big beautiful bill is the increase in state and local tax deduction, which will help everybody in Hawaii, because increasing it
some
from
of us.
Well, some. So yeah, because it increases it from 10,000 to 40,000. So in effect, depending upon where you fall in the spectrum, you theoretically are getting a tax cut. So the amount of your taxes is going to go down. So in theory, if they turn around and reinvest that into the economy, then they have more to spend. So
I think some of the standard deductions a little higher too, I believe.
Yes.
And for retirees, which is a
the Social Security. Anybody over 65 has, with the right income levels, will see a standard deduction that increases.
Well, and then what about the impact on the no tax on tips? Because especially do you know the hotel workers, is that an impact to them at all, or is it primarily just more food service workers?
Food service, yeah. But I doubt that your typical hotel worker is other than in food service. I guess, front desk workers, right, are not earning a lot of their income in tips.
So can I throw out a little change of topic that we haven't really talked about too much about housing costs?
Sure.
Kind of, Carl, what's your take on that one? I feel like this is like your dissertation defense or something, and we're just all like asking you questions, see how you hold up on your feet.
Yeah, Hawaii is holding up better than at least single family. The condo market is still a mess. So I think there's some prospect that the condo market will improve with the state getting things set up to start issuing policies for condo associations. But our forecast is for slow nominal growth. I'd say slightly positive real growth.
Are you talking prices, Carl, or what
prices.
kind of?
Price, not sales. If you look at the sales volume, we're in like almost Great Recession levels.
Yeah.
Right. And that's true nationally as well. So I don't, and so that's that's not, we're not creating a lot of activity from, sales of properties and the tax revenue generated off of that, and then people going out and refurbishing their properties and so on.
Right. Yeah, the inventory, just looking at condos especially, a year ago there was 4.7 months of inventory of supply. Now there's 7 months. It's less dramatic on the single family side. There's still a shortage of homes. People who are looking are having a hard time finding. But it's certainly changing as far as the ability to sell, and the active inventory days on the market getting longer.
Price reductions.
Do you know, was the condo market impacted? Well, I know it was, but by the insurance costs, because I know the hurricane insurance pieces, they weren't. My understanding was some of the condo associations weren't even covering themselves.
They're not fully insured.
Yeah, so then
so you can't get a loan.
Yeah, if they try to sell it, so that depress the sales. But with the state stepping in, do you think that's going to solve some of the issues?
It'll help.
Actually, there is insurance. It's just expensive, and more condos are actually getting fully covered,
Right.
even ahead of any state program. So, the market is kind of solving some of that on its own, but it is more expensive. And yeah, for some of these projects, you need an all cash buyer because Fannie and Freddie will not lend if you don't have the proper insurance. There are some companies that will. Give me a call.
Yeah. I think one other consideration for 2026 is we should have the benefit of some interest rate cuts coming through, which would reduce not only mortgage rates, but also credit card carry, just other debt instruments for people. So that could be a bit of good news for 2026.
I think our forecast for mortgage rates and for long bond rates do have them coming down a little bit, but I'm talking 10, 20 basis points. And partly because, I mean, if short rates come down, it's almost certainly, maybe inflation's will surprise us to the downside, but I don't think that's why short rates will come down. It's probably they'll come down because the economy weakens.
Right.
And if you get, basically what I'm kind of worried about is some sort of very mild stagflation where the economy is weak, but you have at least temporarily elevated inflation. And, that's going to impact long rates and hold them up. I'm actually a little surprised long rates aren't higher than they are, given the deficit creation that we're working so hard to ensure. So, it would make a huge difference if we could get 50 to 75 basis points moved down or 100 basis points moved down in the mortgage rate and start to free up some of the stuck inventory.
Yeah, I think absolutely the FOMC, of course, only has control over the short rates. And if you look back when they first started lowering rates, whenever that was last year, the long end was like, well, I look primarily at the 10-year. It was like 3.5. And it's gone the other way as the rates came down 100 basis points. Long rates actually went up. And we've been in that 4.25%, 4.5% on the 10-year, and that's what the mortgage rates are based off of. We've been there for most of this year, just hovering around those levels. So I would agree with Carl, we very well could see short rates go down. I think there is some justification for doing that. I feel the economy slowing, as Carl was talking about. I can definitely see that happening, but not necessarily the 10-year coming down.
Not much. Yeah.
They usually usually does, but
yeah. But 4% is roughly where the 10-year ought to be for a U.S. economy that's growing 2% real. If the economy was growing at its potential, that's about 2% real GDP growth. And if you're at the Fed's target of about 2% inflation, the 10-year bond rate ought to be right about 4%. It can obviously swing a lot if the economy gets weak enough. But right now, no one's really talking about that kind of a recession, right? Where the Fed pushes short rates back to zero and the long rate goes down to 1 and 1.5% or something.
Yeah. Very good discussion. I think we can entertain.
Did I make a motion?
Yes,
4
please.
points. What was it? 4.6?
You said 4.6 earlier.
Yeah,
I'll
I'll stick
second
to
that.
that then.
I'll
Okay.
second that.
Scott is going to second that motion. Any further discussion?
I don't know, Carl, I think you said 4.7 when you first ran at the very beginning of the meeting, when you hit the button on your thing, but now you're down to 4.6. I'm okay with that.
Either way, it's the same number.
It's basically the same number. It's within our margin of error.
For sure.
Any
So all this
further
discussion made me more pessimistic.
Yeah, by 10 basis points, yeah. Any further discussion? Okay, I shall call for the vote. Carl?
Aye.
Scott?
Aye.
Mike?
Aye.
Regina?
Aye.
Marjorie?
I,
And I also agree. So the motion carries unanimously. Thank you. Always fun to talk about these things with you all. The next item on our agenda is the scheduling for our next meeting for the general fund revenue. And we are looking probably at the week of September 3rd.
That's
I think
correct.
that. So Monday is, I believe, the holiday. So
Yeah, Labor Day.
and Kurt said that he was available toward the end of that week, and I'll just throw out as a starting point maybe 2 o'clock on Thursday, September 4th. How does that look for everyone?
Good for me.
It's good.
good for me.
Yeah.
Okay. Well, I don't think we have to vote on that, do we?
Perfect.
We shall then schedule it for 2 o'clock Thursday, September 4th. Okay, anything else for this committee? If not, meeting adjourned. Thank you all.
Thank you, everybody.
you.
Thanks,
Thank you.
everybody. Thanks,
Good job.
Christine.
Aloha.
Nice to see you,
meet
Marjorie. Yeah, nice to meet
Welcome,
you.
Marjorie.
You're welcome, Marjorie.
Bye.